Good morning, traders. It is Tuesday, July 15th. Taking a look at the charts. Equities are mixed this morning. We do have small caps and the Dow trading negative, but we have the S&P 500 and the NASDAQ trading positive. Probably have something to do with some large tech probably lifting the markets up. Looks like NVIDIA is set to open up sharply higher, about 171. You can see on the bottom chart from the charts up from 164 yesterday. So we're seeing the tech space move higher. Now this is pushing NASDAQ up. We are very close to a 20% kind of upside target for the NASDAQ. Actually, if we take a look at our NASDAQ market, you can see here we had overall market sell-off and recovery after the tariffs kind of news, and we kicked into an uptrend and we're surging higher. The markets have a nice little bull flag here and anticipating it and hoping we're going to see this pop and push higher. It will gap up. We're close to this 560 level to the upside, which is about a 15% move. And more or less, we have like extreme sentiment going on. We saw this with members yesterday in the comments and emails and all of that stuff. But it's really interesting. This is just how the markets and how market participants are driven by emotions, generally just lack having a strategy to follow or just lack following a strategy because emotions take over. It's easy to let the news and your fear of missing out or fear of losing more to make you trump trades and not take them or skip them type of play. Now, what's interesting here is we had the stock market trading up at all-time highs. We had a pullback over here. This was back in February. A lot of members didn't want to get out of the trade, and they stayed in the trade, and a lot of them got stuck in the big collapse. The technicals, the sentiment, everything was saying get out, which is why we got out. And then when the market had a rebound and started to bounce, we had a buy signal. A lot of people thought it was crazy to get back in, even though the sentiment and everything changed from a bounce. More or less, it was a strong enough bounce that it turned into a rally. And of course, our strategy got long. We ended up being able to buy back into this market at a dramatically lower price. So we got out. We were in a position to still make money as the market fell. We got back in at a lower price, and now we're up, 15% on a portion of our portfolio with the QQQ. We're also long the SPY. But my key point here is that during key turning points is when everybody has the most trouble. Nobody wanted to get out of the trade over here. Nobody wanted to get into the trade here. And now we are seeing everyone, not everyone, a good group of people all saying they want to be 100% invested, they want to be long, and they want to outperform the markets here. Everybody's super bullish. So we ping pong around, and these are what make key turning points in the stock market is when you have a ton of pushback. We've got what we call the inbox indicator. Typically, we get a wave of people going against what we're trying to do. And obviously get out of a trade. Nobody wants to get out. Get in. Nobody wants to get in. Now we're actually looking to get out of this trade. We want this market to go a little bit higher, and then really we don't want to be in this market. I believe it actually carries a ton of risk, yet everybody wants to be 100% invested and drive and make a bunch of money. And so this is just the emotions and the waves that we go through. We see it all the time. I've seen this for 26 years. It's never ending. Doesn't matter how much I try to educate and update and inform every day with videos and afternoon commentary updates and stuff. The emotions still trump people, and it's just difficult to get around emotions, obviously. A good example of this is actually what a member shared this morning in the members area, which this is TLT chart. Obviously, TLT, we got out right up here during the COVID crash, right up near the peak. You can see how much bonds have pulled back and how much risk bonds actually carry. People didn't realize you could lose this much in supposedly the safest, a safe haven play. But that is obviously not the case. Typical investment theory, is not safe. You do have to follow price. That's what we do as technical traders. But we had a member this morning really kind of make a good point, and he talked about he went long TLT last October. So let's just take a look over here. Last October we did go long. We had a buy signal in TLT. I can't remember exactly where it was. We had a long, and the trade ended up not working out. We actually had the stock market actually kicked into a buy trigger. So we actually just got out of TLT and moved into the stock market. And if you take a look here, he he went 100% long into TLT in October, which is what our signal said to do. I did the same thing. It went bad quickly as the ACS trade exited down 1 to 2%, which was like a 1.4% loss, I think, that we took, which is pretty minimal. And then, of course, this person unfortunately stayed in. And of course, if we look at price, it continued to sell off. It's hard to see here. Let's just auto scale this, but October was over here, and we can see it has continued to move lower under pressure. And anyway, he hasn't been here a full year, but he's learned to get in the trade when it is triggered and to get out of the trade when it is also triggered. Follow the process. And this is the hardest part for people to do. And this is, these are the signals we have. They are pretty clear. I'd say black and white, but it's red and green. When to get in, when to get out. We say where to, your portfolio allocation, all of that stuff. If you can just commit to a strategy and follow the odds, follow what the strategy is doing. The best thing to do, I find, when we get into it, when there's a trade that you don't want to do, you're nervous, you put on a small position. Still take part of it, because taking part of it is part of the process of building trust. And over time, you just keep scaling up. And we have people who started with very small accounts. They tested the water, and now they're trading millions of dollars with their accounts per trade. And it's just about building trust and getting that understanding that typically when you don't want to do something and there's a trade, it tends to work out. Those tend to be the best ones. The market has a way of trying to get you the most scared to avoid taking the right side of the trade. So I just wanted to share that. Now, overall, if we take a look at the markets today, money is flowing into more or less stocks. It looks like we just had a nice pop in the markets. The Russell 2000, I think, just popped in pre-market. Let's just see here. We just saw a little bit of a push higher. So it went from negative to positive. The NASDAQ starting to push up. If we look at the QQQ, we'll see how this goes. This market is primed and ready. If we see the NASDAQ move higher, I would expect we're going to see Bitcoin move higher. We were long with our band strategy. We're long Bitcoin with the IBIT ETF. And we've hit all of our targets. We closed that out actually last week. And with our strategy, there's multiple different ways to analyze this market. But with our strategy, typically when we hit our max targets is actually usually a level where the market starts to put in a pause or pullback or can reverse direction. And so we hit that last week. And now it looks like Bitcoin could be, the longer term chart, this bull flag pattern is still pointing to about 135. But based on our band strategy and our targets, typically when we hit our targets, we tend to see the market have some type of consolidation or pullback. Had a big upper wick yesterday where it ran up and got hit, sold off, sold down yesterday. You can see how it happened in overall trading. We had a couple gaps up and a gap higher with big volume and some selling. I'm not a big fan of that type of price action. Again, there's multiple strategies and ways you can look at this, but our shorter term band strategy, which stands for best asset now, we got into Bitcoin, we hit our targets, we're now moved out, and we'll wait for a new trade setup. Now, if you're in this is a discretionary trade, a different trade, there is still this bull flag pattern. It has the potential to run up to 135 for Bitcoin. If Bitcoin hits 135, whatever price IBIT is at, you would exit at that resistance level. I like to use the futures as what we chart with, and then you trade with the ETF itself. Now, to kind of add one more layer, if you guys can keep up, is typically when the stock market is hitting a key target, like a 15%, we tend to see the stock market stall out and have some type of reset, some type of correction or pullback, whether it's just a little pause or pullback and the trend resets before going higher, or it could be something much bigger. We don't know. But typically, once we hit this level, the markets have some type of reset. And if the market has some type of reset, we are most likely going to see, let me just go back here to Bitcoin. If the market has a reset, we're probably going to see Bitcoin also have a reset. All these things move a lot together. You got to be aware of that. And so that adds a little bit more risk to this position. Let's take a look over at gold. We do have gold and silver. They're mixed this morning. Gold's flatlining here. And flatlining is a good thing. It means you rally, you flatline, rally, flatline, rally, flatline. It is holding up very nicely, primed and ready for any chaos, any bad news in the market. Gold should shoot higher. Silver is kind of in the same boat. If we take a look at silver futures, it's already kind of had that pop and squeeze up. And now it's probably going to flag and take a bit of a breather. Maybe gold is the next one to pop, while silver maybe underperforms a bit. They kind of sometimes flip and flop between which one is leading and lagging and how they unfold there. One of the members wanted to look at Ethereum. I only have the Ethereum Grayscale ETF, but again, to me, it's fairly similar to Bitcoin in terms of it's had a run up, it's been pausing, it's breaking out, and has potential to continue to move up at this point. And move with the stock market, move with Bitcoin. Kind of feel like they're a very similar tide type of play, but I don't follow Ethereum. Just this chart pattern is bullish. I'm not a huge fan of the price swings. I'm not a fan when something swings up and then swings down. Like talk about a shakeout. And this is a fake out. It shakes out the shorts, gets people long, and then it comes down here, and then it shakes out the longs, gets people short, and then it takes off and hits a new high and gets the shorts out. It is just shaking the heck out of people. I'm not a fan of charts that do that. Nobody, I think, is. Makes it very difficult. But the pattern overall, the underlying pattern is still bullish. Definitely some volume moving into it, so there's some interest there. If we take a look over at the ban hot list, you can see here we have some new triggers. I mentioned last night in the evening update, there are some new triggers. Long story short, if we look at these top sectors, it is all the most aggressive of ETFs. They're all, money is piling into this market. Again, everybody wants to be fully invested. They're trying to make as much as they can. They have really high expectations of big returns. That is a bearish sign. We see it with all of our followers and our comments. All of those things are a really good indicator that we're getting close to a market pullback. It's just a matter of letting the market mature and do its thing. But we do have some new triggers. URA has a new trigger. Now, these are just discretionary side trades. If the stock market has this bottom indicator here that's green, if it is green, that means the stock market is favorable to hold stocks. So you can be trading stocks. You can trade new triggers. These are short-term momentum triggers, meaning price is just more or less turned up. It's showing renewed energy for potentially a move. You can see the last trigger was over here. Obviously, we played a very nice move with uranium. We hit all of our targets to the upside. URA, we're out, and it actually is generating a new trigger and some pretty significant upside momentum as of yesterday. We look at a couple other ones here. How this works is this green line here is how many days ago a trigger formed. So ARK had a trigger 32 days ago, for example. It's up 26%. So if we take a look here, 32 days ago, it's up fairly significant. If we take a look at the most recent ones, it's interesting. As we go down this list, they're not as bullish in most cases, but it doesn't always mean that. For example, there's a new trigger as of today for carbon, the carbon ETF. If we look at the carbon ETF, the long-term 150-day moving average is sloping down. The 50-day is still kind of at or below it. So it does overall have a longer-term trend that is down. Yes, the chart pattern actually looks bullish, but the tide is kind of still falling in this space. So I'm not too excited. If we actually go down to GLD, which is gold, which actually had a trigger 1 day ago, gold is kind of the opposite scenario. If you look at it, the long-term tide is rising. Price has been consolidating, taking a breather. So you want to usually trade something and trade with the underlying tide. If the tide's going up, you should expect price to go up. So there is a new trigger in gold. It's getting into the pennant formation. It's getting closer to potentially a breakout and a rally. And of course, it had that 1 day ago. If we go and take a look over at SLV, it had one 2 days ago on that big pop. It really triggered that move. Now it's trying to digest, as I just mentioned. It's had a big pop, and now it's trying to figure that out. But it does still have more upside potential. I prefer gold myself just because it's more stable. It's a bit slower mover, and gold hasn't broken out yet. You can see SLV has already hit its 618. It's now taking a pause and breather. If you hit the 618 and pull back, we generally go up and hit that measured move to the upside, the 100% measured move, which is the 1. So all these things, this whole hot list you get access to, gives you insight as to how you could take advantage of things. It's important to understand the moving averages and all of that stuff. Anyways, that's it for now. We'll see how the markets shake out. I think we're going to see some volatility today. Hopefully we see the markets pop and push higher. And eventually we'll hit some more targets with our index ETFs, allow us to reduce our market exposure. I know everybody wants to be long. I want the exact opposite. Typically when I want in and we have a buy signal, nobody wants in. When I want out, everybody wants to stay in the trades. And that's the difference between having a strategy and understanding the market cycles and sentiment and indicators and all that stuff and statistics. Knowing when the market moves roughly 15% from a trigger, one of our specific triggers, we tend to see the market maybe go a little bit higher, but it eventually has a correction and a reset and allows us to get back in at the same or a better price, over a few weeks later once that correction takes place. So I never worry about missing a trade. There's always going to be more trades. And FOMO is the worst silent killer. It's more painful than taking losses. All kinds of stats have taught us. People will rather take a loss than watch a gain happen without them. And that's where we are right now. I can feel the pain. I can feel the anger and frustration for those who are not in the markets, for those who want to be more aggressive versus, index plays, or we carry a large percentage of cash right now. And that's simply because we've been scaling out of our positions as we hit targets, locking in gains, reducing our exposure, managing our risk, because eventually there will be a reset. And if you manage risk, this is one thing people don't fully understand in most cases. If you're managing your risk in positions, you are going to underperform during a rising market, especially a very strong rally. Where you play catch up is when the market goes sideways or the market corrects and sells off. We don't give back our gains. We keep our money and we make more money as the market pulls back, where everyone else gives back all the gains that they thought they had, and they vaporize. And that's the difference between what we do is we manage positions to keep ratcheting our account higher. We keep locking in gains. Our accounts keep hitting new all-time highs with the ACS strategy, and which is this strategy here. And that is the value. That is what we do, is peace of mind, knowing that it doesn't matter when it rolls over, we're not going to take a big loss. And we're actually going to be able to find a way to continue to grow our money as the market sells off and everyone else is losing their shirts and panicking and all of that. Anyway, that's it for now. Talk to you soon. Bye-bye.